What is a flash loan, you ask? Well, a flash loan is simply a smart contract that creates a loan in cryptocurrency where you can borrow millions of dollars with absolutely no collateral. The catch is, you must pay the flash loan back in the same transaction that you bought it with. Welcome to Asianix Media, where we explain Asianix's topics in a way that makes them so easy to understand. Let's dig in. So like I said at the beginning, a flash loan is simply a loan where you can borrow massive amounts of money for free, but you must pay it back almost immediately. How can we do this? If you make a profit, then you pay back the loan and keep what's left over. When I say a short period of time, I mean like 13 to 20 seconds, because that's about how long an block takes to be validated right now. Currently there are around 4 main uses of a flash loan. We're going to cover all 4 in this video, but if you're in this far and you already understand what a flash loan is, consider other video that is more advanced. First, flash loan trading arbitrage. Imagine a situation where you could buy an apple for $1 from your mom, and then sell that apple to your dad for $2. You could easily double your money. You just keep taking the money that you have and doubling it. Well, this is exactly what trading arbitrage is, except in the case of cryptocurrency, you might be able to buy a token for $100 at Uniswap and then turn around and sell it to PancakeSwap for $101, making a single dollar of profit. Repeating the process, however, due to the high competitiveness of the market, the arbitrage opportunity typically disappears after the initial trade, making it difficult to continue capitalizing on the price difference. However, with flash loans, you can borrow $100 million of money that is not yours to do this trade at an instant. This is one of the most common uses of a flash loan. Second is collateral swap. Let's say you are optimistic about Bitcoin's price increase and doesn't want to sell, and yet you need money for expenses. You did so by lending out your 1 million worth of Bitcoin in Aave so you could earn interest. And because of that you had collateral which allow you to borrow out $500,000 to pay your expenses. Then you realize after doing that in a few hours, other platform like Compound provide higher interest rate for your Bitcoin. And because of this, you would have to pay back your $500,000 which you already used up for expenses to be able to get access to your Bitcoin and then deposit it to Compound to earn higher interest. However, if you used flash loan, you could do all of this at once instead of multiple step. Simply use flash loan to borrow out the 500,000 USDT to swap out your Bitcoin, and lend directly to Compound for higher interest. With that, borrow out 500,000 USDT from Compound and repay the flash loan. And that way you essentially changed out your collateral without touching the true $500,000 that you have spent and earning a higher interest on the platform. Thirdly, is liquidation. So let's say you spotted a lucrative opportunity in a blockchain that requires a large sum of money. Let's say Brenda is in financial distress and needs to sell her asset quickly at $1 million, while Claire is looking to buy a similar asset for $2 million. You need to act fast before someone else seizes the deal. Traditionally, you needs to obtaining a financial loan from the bank involves a lengthy process with extensive paperwork. By the time you have the funds, the opportunity may already be gone. So through flash loan, within the same transaction, you can borrow $1 million to purchase Brenda assets and sell the asset to Claire at $2 million. Then return the $1 million that you borrowed and keep the remaining $1 million profit. Fourth, it's called flash loan attacks. So flash loans can actually be used to exploit vulnerabilities in certain smart contracts. For example, someone found out that there was a bug in the Pancake Bunny protocol. If you don't know already, Pancake Bunny is a yield farm that pays users in Pancake Bunny for users lending their coins and tokens. In short, there was a bug that the exploiters found that created a lot of Pancake Bunny tokens. So what did they do? These exploiters borrowed around $700 million, used it to exploit Pancake Bunny, and then paid it all back in one transaction. Well, what did they end up with? They found a way to mint 7 million Pancake Bunny tokens and then immediately sold them, earning them a nice $45 million. In short, they borrowed $700 million for free. Use it to exploit a bug that gave them $45 million and then paid back the original $700 million. However, Asianix are against it. However, we use it to inform protocol about their vulnerabilities. We hope that you enjoyed it. And most importantly, we hope that you learned something about flash loans. If you did, Please check out other videos that talk about how Asianics utilize all this purpose using AI machine learning and neural network to create parameters and datasets to achieve a low-risk strategy through the use of flash loan.